Banks are now scoring you using your actual bank account data, not just your credit report. For decades, your credit score came from one place, what the three bureaus had on file about your loans and credit cards. That's no longer the whole picture. Here's what that actually means for you. In plain terms, banks and scoring companies can now look directly at your checking account activity, not just your credit history, when deciding your risk. To understand why this shift happened, you need to understand a real limitation in the old system. Traditional credit scoring only works if you have credit accounts to score. No credit cards, no loans, no score, even if you manage money responsibly every single day. The industry calls this being credit invisible or having a thin file. Millions of people fall into this category, not because they're financially irresponsible, but because they simply haven't opened many credit accounts yet. Recent immigrants, young adults just starting out, and people who've deliberately avoided debt all tend to fall into this same blind spot for very different reasons that have nothing to do with financial risk. VantageScore built a model specifically to close that gap, and the mechanism it uses is called consumer permissioned bank account data. Put simply, with your explicit permission, a lender or scoring company can now pull real transaction history directly from your checking or savings account and use that data as an input into your credit score. Here's where it gets more specific to how banks actually process this. A DDA is simply the technical term for a demand deposit account, in plain English, your everyday checking account, the kind you can withdraw from anytime without notice. When a bank or scoring model pulls DDA data, it isn't looking at your balance the way a loan officer glancing at a bank statement might. It's looking at patterns, deposit consistency, whether your account regularly avoids overdrafts, how your balance trends over weeks and months, not just what it happens to say today. Most people hear this term and move past it. Don't. This is fundamentally different information than anything a credit bureau has ever collected, because it comes directly from how you actually manage cash, not just how you repay debt. This connects to something we've discussed before on this channel, trended data, the practice of scoring models reviewing up to 24 months of history instead of a single snapshot. Bank account scoring takes that same trended philosophy and applies it somewhere credit bureaus have never had access to: your actual liquidity day to day. Strip away the banking language, and here is what is actually happening. The model is trying to answer a question your credit report literally cannot answer. Not, does this person pay debts on time, but does this person consistently have enough money moving through their life to be a reliable borrower? Those are related questions, but they are not the same question, and for millions of people, the second one paints a very different picture than the first. Here's a concrete example of why that distinction matters. Someone with no credit cards and no loan history might look completely invisible to a traditional bureau-based score. Zero data, no file, no number. That same person, if they've held a checking account for years with consistent deposits and no overdrafts, has an enormous amount of real financial behavior data sitting in their bank records that traditional scoring never touched. VantageScore's own reporting says this expanded approach, combining machine learning with trended data, is able to generate scores for tens of millions of consumers who previously had no score at all under the traditional model. Now, here's something worth sitting with for a moment because it reframes the entire conversation around what a credit score even measures. For most of your life, you've probably thought of your credit score as a measurement of how you handle debt. Bank account scoring quietly expands that definition to include how you handle money in general, whether or not that money involves any debt at all. That's a meaningful philosophical shift in what the number is actually trying to capture, even before you get into the technical mechanics of how the data moves. Let's go deeper on the mechanical side of how this data actually gets pulled, because the plumbing behind it matters. When you permission a lender to access your bank account data, that connection typically runs through a third-party data aggregator, a company that specializes in securely linking your bank account to whatever institution is requesting the data. Think of a data aggregator as a translator sitting between your bank and the lender. Your bank speaks one technical language, the lender's system speaks another, and the aggregator converts your raw transaction history into a standardized format the scoring model can actually read. This is the same category of technology that powers budgeting apps and financial planning tools you may have already used, just repurposed here specifically for credit evaluation. Here's the part that's easy to miss in most coverage of this. Because it's permission-based rather than automatic, this data doesn't show up on your file the way a missed payment does. It only gets pulled and used in the specific context where a lender requests it and you agree to share it. That's structurally different from how your credit report works, where furnishers report data continuously whether you're actively applying for something or not. There's a consent layer here that's structurally important to understand. This data sharing isn't automatic or invisible the way bureau reporting has traditionally worked. It requires the consumer to explicitly permission access to their bank account data, typically through a secure data sharing connection at the point of application. Federal regulators have also been working on rules specifically governing this kind of data sharing, aimed at giving consumers clearer rights over their own financial data and how third parties can access it, separate from the scoring question itself. Put simply, the regulatory conversation happening around this isn't just about whether banks can use your data. It's about making sure you actually control who gets access to it and can revoke that access. Let's talk about who's actually adopting this, because it's not theoretical anymore. According to VantageScore, banks, fintech companies, and credit unions across the industry are integrating consumer-permissioned data as part of how they evaluate applicants, particularly for people the traditional bureau system has historically underserved. Put simply, this isn't a future concept. It's an active part of how a growing number of institutions are already making lending decisions right now, running in parallel with traditional bureau-based scoring, not replacing it entirely. It's worth being precise about what this doesn't do too, because that matters just as much as what it does do. This isn't a system where every bank automatically sees your checking account the moment you apply for anything. It only activates in situations where you're specifically asked to connect your account and where you agree to that connection. And it isn't currently a universal requirement. Plenty of lenders still evaluate applicants using only traditional bureau data, especially for consumers who already have an established credit file. So here's the full mechanic, start to finish. Traditional credit scoring only works if you have credit accounts on file, which leaves millions of people either invisible or thinly scored despite responsible financial behavior. VantageScore and other scoring models built a mechanism using consumer-permissioned bank account data, sometimes called DDA data, to close that gap. That data moves through a third-party aggregator that translates your raw transaction history into a format a scoring model can evaluate, capturing deposit consistency, overdraft avoidance, and balance trends over time. This works alongside the trended data approach used in newer scoring models, applying that same multi-month lens to your actual cash flow instead of just your debt repayment. It requires your explicit permission to access, activates only in specific application contexts, and exists alongside, not in place of, traditional bureau-based scoring. In plain terms, your bank account itself has quietly become a second data source banks can use to evaluate you, running alongside your traditional credit file, and only with your direct permission each time it's used. This is one of the biggest structural expansions in what creditworthiness even means, and it's happening industry-wide right now, often without most consumers realizing their bank account data is being used this way at all.